Hey everyone, welcome back to Corporate Decoder, the place where we dive into the sometimes murky world of corporate filings. Today, we're cracking open a Form 8K from John Deere Capital Corporation. Now, don't let Capital Corporation scare you off. It's not about tractors today, well, not directly. It's about how they're financing those tractors and how they're getting the money to do so and what it may mean for the company and its investors. We'll see what kind of financial moves Deere is making. This report is dated March 6, 2025. That means it's giving us a snapshot of something important that happened around that time for John Deere Capital Corporation. This particular 8K filing is like an immediate alert system for significant events. It ensures that investors know sooner rather than later. This Form 8K is a current report. Companies use these reports to tell investors about big changes. Think of it as an oh or aha moment that the company needs to share right away. These events can be anything from big contracts, executive departures, or even changes in financial conditions. Anything that might sway investor decisions. Let's talk about the company itself. John Deere Capital Corporation is basically the financial arm of the famous John Deere. They help finance those big green tractors and other equipment that farmers and construction companies use. They provide loans and leases, making it easier for customers to afford John Deere products. So, if John Deere Capital Corporation is doing well, it usually means that farmers are buying equipment, and that's generally a good sign for the agricultural economy. Now, let's get to the heart of this 8K filing. It mentions 2.00% senior notes due 2031 listed on the New York Stock Exchange. Basically, John Deere Capital is borrowing money. They're issuing bonds, which are like IOUs, that promise to pay back the money with 2% interest per year until 2031. These senior notes mean that if John Deere Capital Corporation were to, in the worst-case scenario, go bankrupt, these bondholders would get paid back before some other creditors. Here's where the filing gets specific. Item 9.01 tells us that there are financial statements and exhibits which are extra documents attached with this report. It states that on March 6, 2025, the company issued $500 million worth of floating rate senior notes due March 6, 2028. Floating rate means the interest rate on these notes can change over time, unlike the 2% fixed rate we talked about earlier. This is a way for Deere to manage its borrowing costs. If interest rates go down, they pay less, but if they rise, they pay more. These notes mature or come due in 2028. So John Deere Capital Corporation has to pay back this money in full by then. This new debt was issued under something called a shelf registration statement. Think of this as a pre-approval from the SEC, Securities and Exchange Commission, to issue bonds or other securities, without needing to get approval every single time. It saves time and paperwork. Looking at the exhibits, we see that there's an opinion from the law firm Kirkland & Ellis LLP. This is a legal opinion about the notes, essentially saying that everything is legal and above board. It is routine but important because it gives investors confidence that the issuance of debt is legally sound. There's also a consent from Kirkland & Ellis LLP, meaning they're okay with their opinion being included in the filing. It's like giving their permission for everyone to see their homework. The last document, Cover Page Interactive Data File, relates to XBRL, which stands for Extensible Business Reporting Language. This is a way of tagging the information in the report so computers can easily read and analyze it. It makes it easier for investors and analysts to compare John Deere's financials with other companies. So, what does all of this mean? John Deere Capital Corporation raised $500 million by issuing floating rate notes. This gives them more cash on hand to finance equipment purchases. The company is probably seeing strong demand for John Deere products and needs more capital to support those sales. The use of floating rates means John Deere is betting that interest rates will either stay the same or decrease over the next few years. If interest rates go up significantly, their borrowing costs will increase. Now, let's step back and look at the bigger picture. John Deere is a major player in the agriculture industry. Their performance is often a good indicator of the overall health of the farm sector. If farmers are buying new equipment, it suggests they're confident about their future profits. The decision to issue floating rate notes also speaks to John Deere's financial strategy. They're clearly trying to balance their borrowing costs with the risk of rising interest rates. It's a calculated gamble. If rates stay low, they win. If not, they could face higher expenses. From an investor's point of view, the bonds themselves represent an investment opportunity. However, investors need to consider the risk. Can John Deere Capital Corporation pay back the money by 2028? That depends on the overall economy, the agriculture sector, and John Deere's own financial performance. One thing that should be considered a risk is the price of farm commodities such as corn and soy. If these prices fall, farmers will have less money to spend on equipment. New environmental regulations could also impact demand for certain types of machinery. As for John Deere's strengths, they have a strong brand name and a loyal customer base. They're also investing in new technologies such as autonomous tractors and precision agriculture, which could give them a competitive edge. A weakness might be their reliance on the agriculture sector, which can be cyclical and unpredictable. This is because their financial performance hinges on the agricultural industry, which can be unpredictable due to its cyclical nature. In conclusion, this 8K filing tells us that John Deere Capital Corporation is actively managing its finances to support its lending operations. The decision to issue floating rate notes is a calculated risk, but it could pay off if interest rates remain low. Overall, John Deere seems to be in a solid position, but investors should always be aware of the potential risks. Thanks for watching. If you found this corporate decoding helpful, give us a like, leave a comment, and of course, subscribe for more deep dives into the world of finance. Until next time,